What is a mutual fund? A complete guide to benefits, risks, and comparison with fixed deposits. Hey there, welcome back to the Investment Professor channel, where we simplify investing so you can make smarter decisions. Today we're talking about a financial product that you've probably heard of, but may not fully understand: mutual funds. What are they? How do they compare with fixed deposits? And most importantly, what are the risks and rewards? Let's dive in. What are they? How do they compare with fixed deposits? And most importantly, what are the risks and rewards? Let's dive in. So what exactly is a mutual fund? A mutual fund is an investment vehicle that pulls money from many investors to invest in stocks, bonds, or other securities. The pool is managed by professional fund managers who use their expertise to invest in a diversified portfolio of assets. In return, you get units or shares in the fund, which represent your proportionate ownership in the investments. Think of it as investing in a basket of different assets. This diversification can reduce risk because you're not putting all your eggs in one basket. Now, the key thing about mutual funds is that they're professionally managed. A team of financial experts does all the heavy lifting, choosing where to invest, when to buy, and when to sell. As an investor, you don't need to monitor the markets daily. You trust the fund managers to handle that for you. But of course, this comes with management fees. Let's break down the benefits of mutual funds. Diversification. Like I mentioned earlier, your money is spread across different types of assets, reducing risk. If one investment doesn't perform well, others may balance it out. Professional management. You don't need to be a financial expert. Fund managers do the research, decision-making, and adjustments for you. Liquidity. Mutual funds are relatively liquid, meaning you can easily buy or sell them on most business days. It's not like being locked into a fixed-term deposit. Flexibility. Mutual funds come in various types: equity, debt, hybrid, and more. This gives you options based on your risk tolerance and investment goals. Now let's compare mutual funds with a very popular low-risk investment: fixed deposits, or FDs. Mutual funds and fixed deposits differ significantly in key features. Mutual funds offer market-linked returns, which can be higher but come with volatility, while fixed deposits provide guaranteed, low-risk returns. In terms of risk, mutual funds range from medium to high, depending on the fund type, whereas fixed deposits are low risk with virtually no volatility. Liquidity is more flexible with mutual funds, though exit loads may apply, whereas fixed deposits have a fixed tenure and premature withdrawals often incur penalties. Tax-wise, equity mutual funds are more efficient, benefiting from favorable long-term capital gains tax treatment, while fixed deposit interest is fully taxable. Mutual funds are professionally managed, whereas fixed deposits require no management, just a deposit and wait. With mutual funds, your returns are linked to market performance. So while they can be higher than fixed deposits, they also come with more risk. Fixed deposits, on the other hand, offer a guaranteed stable return, but usually at a lower rate, especially when adjusted for inflation. Of course, mutual funds are not without risks, and it's important to be aware of them. Market risk. Your returns aren't guaranteed. If the stock or bond market performs poorly, your mutual fund could lose value. Interest rate risk. For bond funds, if interest rates go up, bond prices usually fall, which can lead to losses. Exit loads. Some funds charge a fee if you sell your units within a certain period, which reduces your returns. If you sell your unit fees, even if the fund performs poorly, the management fee has to be paid. This could eat into your returns. So, should you invest in mutual funds? If you're looking for a hands-off, diversified investment with the potential for higher returns than fixed deposits, mutual funds can be a good option. But remember, the risk is higher too. They work well for long-term goals, like retirement or saving for a child's education, especially if you're willing to weather some market ups and downs. To wrap it up, mutual funds are a great way to invest in a diversified portfolio without having to constantly monitor the markets yourself. But like any investment, they come with risks, so make sure you're comfortable with those before jumping in. Thanks for watching. If you found this helpful, take a moment to reflect on what type of investor you are. Are you someone who values safety? Or are you willing to take on some risk for potentially higher returns? Thanks for sticking with me throughout this video. Now it's time to put what you've learned into action. Take notes, learn from it, and let's work towards success. Let's grow together? Drop your questions or thoughts in the comments below. Thanks for watching, and I'll see you in the next video.